Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Roseen. Thanks for joining me today. I'll be reporting estimated net flows into and out of the conventional fund business and also ETFs for the weekend of Wednesday, January 13th, 2021. Investors injected about $22.9 billion into the fund business, again, including ETFs this week. And this was basically on some mixed news. I mean, we heard some disappointing news that the non-farm payroll numbers for December came in below expectations, actually losing 140,000 jobs. And that was against what analysts had expected of a 55,000 job increase. Now, again, the reason we saw this is because investors heard back from President-elect Joe Biden, who said that he was going to do whatever it took to keep get money into both the employed and unemployed's pockets, so they could keep on moving on with their spending and their life manners and habits and the like. Also, he said he would increase the number of people being inoculated, getting the vaccine against COVID-19, and set some goals for his first 100 days, and I think that was a boon in the market. In fact, we saw a couple things. We saw risk on, and we also saw rotation. And before, we were kind of talking about one without the other. Before, we had the play into the stay-at-home stocks and the technology stocks, and then several weeks for the past several weeks, been seeing money going out of those and back into the small cap value-oriented stocks, out of favor issues and the like. Well, this week we saw the Nasdaq Composite actually push to the strongest return out of the broad-based indices we follow, 3.05% return for the fund flows week. Then we saw the Russell 2000, which is considered those out of favor plays, right, small caps, and actually take the next best return at 2.63%. However, one of the things that we did see this week, and actually started the prior Wednesday, basically we saw that the 10-year Treasury went above 1% for the first time since I think it was March. But what we saw by the end of close of business, for the fund flows week this last Wednesday, basically we saw the 10-year Treasury go to 1.10%. So that was a change, and we did see some inflationary concerns out there. I know the Fed is coming out and saying that they don't think it's inflationary. It'll be a while before inflation rears its ugly head. But I think some investors have decided to actually go out and pay attention to it and maybe start patting the coffers of, for instance, loan participation funds or tip type of funds and the like. And so we did see movements into that area. Well, let's see how this news panned out to our macro groups and see what happened in the fund business overall. Basically, when we're taking a look at, again, this is including ETFs and conventional funds. Equity funds took in about $5.4 billion. The next group was the taxable bond funds, taking $9 billion, pretty handsome number there. $2.6 billion for muni bond funds is actually really good, and we saw some records set there this week as well. And money market funds took in about $5.9 billion. So we've been seeing this kind of story where money goes into select areas and out of certain areas. A couple of weeks ago, we were talking about all money coming out of money market funds. The last couple of weeks, we've seen inflows into money market funds. We'll get into detail here in a second. Let's go ahead and see basically how this, though, panned out when we take a look at the macro groups. And the first one we'll start out with is equity funds, and talk about equity funds, and this is conventional funds, ETFs. Basically, we saw that they had a 1.79% return this week, 11th consecutive week of plus side performance. However, as has been the case for quite some time, we saw outflows, $9.4 billion this week, third consecutive week they've seen outflows. 4 weeks ago, there's some slight inflows, but before that, it was like 30 consecutive weeks of outflows. This has been a story we've been talking about for quite some time. Massive outflows, even though we've had some just fantastic returns in the market. Domestic equity funds lost about $8.1 billion. This is the third consecutive week also that they've seen outflows, and they had a 1.93% return. It's the 11th consecutive week they've seen plus side performance, and the same thing goes for non-domestic equity funds as well. They saw $1.3 billion outflow, again, third consecutive week they've seen outflows, and they had a 1.49% return, and it's the 11th consecutive week they've seen plus side performance. So really, I'm going to still call it a head scratcher. Obviously, people are moving out of funds and moving into the ETF arena. This has been happening for quite some time. I guess you can kind of refer to it disintermediation. It's not really the right term, but it's the right idea. Large cap funds on the conventional fund side were the big loser, lost about $6.8 billion. And then we saw net redemptions from mid cap funds as well, about $762 million. On the world side, we saw international equity funds hand back about $618 million, while global equity funds lost about $641 million. So that was the story on that, and that's been the story for quite so many months. we saw ETF investors do just the opposite. Now, you and I are the investors. We buy the securities, but really the people that are making the flows, that are going out there and creating and destroying shares are called authorized participants. And authorized participants actually put money to work in this group for the 5th consecutive week. Let's go ahead and take a look at that chart and see what happened. $14.8 billion in net new money came into that group. Again, I told you it's the 5th consecutive week they've seen net new money come into their coffers. And what we saw at the top was the Financial Select Sector Spider Fund actually take in about $3 billion, obviously an ETF. The iShares Core MSCI Emerging Market Exchange Traded Fund, here's part of that rotation I was talking to you about. Basically, investors were talking about getting away from maybe going after more non-domestic equity, thinking that domestic equity is getting a little long in the tooth. They took in about $1.8 billion. But at the bottom, again, people kind of turning off that safe haven play. Spider Gold lost about $906 million. And then we saw the Invesco Russell 1000 Dynamic Multi-Factor ETF lose about $870 million this week. So that is quite of a difference, right? You see money coming out, and I was just saying that retail investors are kind of, even though we're having fantastic returns, getting out of money market funds and obviously going after maybe the more tax efficient, maybe the cheaper, less expensive, I should say, rather than cheaper product as far as ETFs are being offered as well. Well, let's go ahead now and take a look at what happened in the fixed income arena as well. So for the 4th consecutive week, they took in net new money, this time to the tune of about $6 billion, slightly less. 3rd consecutive week, though, they've seen plus side performance. It's 0.18% this time. And the big attractor of investors' assets was corporate investment grade debt funds. They took in about $3.9 billion. A big chunk of that, though, went to loan participation funds. And I know everybody goes, corporate investment grade is not loan participation funds. In fact, loan participation funds are loan participation because they do better in rising rate environments. They are generally not investment grade debt, but because of the legacy of this product, loan participation funds have been in there way before we bought the weekly fund flows from AMG. Is probably 10, 12 years ago, and investors really wanted us to keep it in there so they could track their flows better. Anyway, so they were a big group as far as taking in money. There was some records set as far as corporate investment grade went, and of course it was not really the corporate investment grade, but loan participation. Flexible portfolios funds took in the next largest amount, about $893 million, and at the bottom of the barrel we saw balanced funds, $133 million as far as outflows goes out of that particular group. And as I've said before, I'm not a big fan of actually having balanced funds in this group because there are some 60-40 splits, equity funds, 60-40 fixed income. So I would rather see mixed asset funds being included in the equity universe. But again, this was kind of a legacy piece as well. Well, let's go ahead now and see how that panned out, though, for the fixed income ETFs. Kind of same story that we saw with this group as well. Basically, fixed income ETFs took in about $3.1 billion. Second week in 3, they've taken in net new money. At the top of the group was the iShares MBS ETF, taking about $1.1 billion. And then we see iShares iBox Dollar Investment Corporate Grade Bond Fund basically take in $639 million. And at the bottom, remember I told you people were getting away from the safe haven plays, getting away from treasuries, particularly long duration treasury. iShares 20-plus year treasury bond ETF basically saw about $840 million in net redemptions, and the iShares iBox Dollar High Yield Corporate Bond ETF lost about $626 million from their group as well. So that brings us now to a little bit of a story I was telling you about. We saw some records on the muni bond fund side this week, and let me go ahead and show you some pictures on that one. Basically, when we take a look at the muni bond funds, wrong slide, apologize, move on to this. But next time when we go into the muni bond funds, basically we saw that they took in about $2.2 billion. It's the 3rd largest net inflows they've seen on record and best since last June. Basically what we saw was the 10th consecutive week of net new money coming into this group, even though they had a 0.02% decline by market standards. This first week in 12, they've actually seen negative performance, but the big winner here was high yield muni debt funds, taking in $984 million. They had a 0.22% return plus side performance, and that was a record net inflows going all the way back to 1992 when we began tracking flows on a weekly basis. So again, best high yield muni bond fund inflows on record. Next group that actually took in the next best amount of money was the general insured municipal debt funds, taking in $757 million. And then, if we take a look at the municipal bond fund side of the ETF arena, for the 12th consecutive week, they saw inflows, this time to the tune of $437 million. So that was the story there. I told you that we saw net inflows into money market funds, and let's go ahead and take a look at this slide that shows that. Basically, money market funds for the third week in four saw net new money come to that group. $5.9 billion. Like I told you before that, we did see some pretty big outflows, especially in December, as people were either getting ready to, rally in the markets or put money back to work or whatever the case may be. We've seen money come into this group again for 3 weeks in four now. How it broke out was taxable money market funds, so about $6.7 billion come into that group. And how that was broken out was institutional investors actually were the big adders. Last week and the week before, it was just the opposite, but institutional investors put about $8.7 billion back into money market funds. Now, when I say institutional investors, remember that the institutional accounts could be your or my 401k as well, right? That's considered institutional accounts by many people as well. So don't think of this as necessarily just being the smart money, as some people refer to. However, retail investors did take money out, about $2 billion this week, and that brought us to what our 6.7 I was telling you about. Tax-exempt money market funds, so about 848 in net redemptions. That makes total sense considering we had some record flows into munis, people in search of yield and the like. That was kind of a consistent story that we've seen for quite some time. Now that is it for me today. However, we heard some news on Friday. Basically, December retail sales came in 0.7% lower in December. We were expecting some positive numbers. Everybody expects it for December, right? Because usually you get some spending because of Christmas and all the other celebrations that are going on, Hanukkah and the like. So basically we saw some disappointing news there. And then also we saw their PPI, Purchase Price Index, basically Producer's Price Index, basically losing as well. Actually, it gained 0.3%, but people thought it was going to be higher than it was. So that was kind of why I would call it a loss. Basically, most analysts thought we'd come in a little bit higher, about 0.4%. And I don't think that's much of the story at all, but we take a look at the earnings seasons just started. We saw the three major banks out there actually start off the earnings seasons. You've got JPM Citi and then Wells Fargo, and they came out and beat earnings expectations quite handily actually, but they all got beat up. And I won't say they took a black eye or whatever, but they did poorly, and you'd expect them to go up because again, interest rates are a little bit higher, right? 1.10% for the 10-year Treasury. That bodes well for interest-producing businesses, right? As far as be able to get some more money out of the revenue side of the system. But I think again, what happens is investors are a little bit concerned. The market appears to be a little bit long in the tooth. We saw some disappointing non-farm payroll numbers come out. And overall, people I think are just a little bit concerned with what's going on with the increase in COVID-19 cases, even though we have the vaccine out there. Well, that's it for me today. If I haven't done a deep enough dive, you can go to our site at www.lipperusfundflows.com or join me next week when I'll talk to you about flows trends of the week. Thank you for joining me. My name's Tom Roseen, wishing you the best in your wealth planning and creation.